Now, the Fed is projected to start knocking down the rates. Okay. They pushed the can down the road, but they're going to meet again in May. So what happens if they say, hey, we're going to drop rates by 0.25% or 0.5%? Well, if they do that, the insurance companies, their payout rates, their MIGA rates, their income rates, their caps and pars, they're all going to come down. There's less profitability. So if you look at it, I've been yelling this from the rooftops ever since the middle of last year. This is an opportunity of a lifetime. Think of it. The highest rates that we've seen before on the annuity space, more people turning 65 this year than ever before in history, okay? And we have an opportunity to help preserve their money when we are way overdue for a market correction. I mean, you don't want to look back in 5 years from now and be like, damn, I wish I would have just gone a little bit harder, made some more phone calls, actually wasn't scared and did a workshop. I wish I would have done something differently, because this is an opportunity that will not always be here. Now, will the annuity opportunity always be here? Yes, you can sell annuity. We were hyper successful in 2019 and 20. And the interest rates were like 0. There's still opportunities to help people and to win. But this is a prime opportunity to really capitalize on it, especially if you've ever sold a life insurance policy in the last 5 years or 10 years, or even just 2-3 years ago. You should be reshopping that for people. Don't you expect your home and auto person to reshop stuff every now and then? Reshop it. We have written almost $1 million in premium in the last 6 months in life insurance, just from going back through our old book and telling people, hey, look, let's reshop these rates. Things have come down. There's better opportunities. There's 1035s, all of this. Okay. Especially if you sold a bunch of life insurance that was IUL focused, if you're one of those agents, because if you've ever sold an index universal life policy and you actually look at the annual statements over the last 5 years, not only yourself, you should be disappointed, but your clients are probably pretty disappointed too, because it was pretty misleading on the rates of returns. And then we had a separate call on this, but it's a great opportunity to say, look, things have changed. How about we capitalize on the money that you do have in there, turn it into something that is actually guaranteed for life and reduces your premium and gives you more coverage. We do that all the time. We replace policies. There's nothing wrong with replacing policies as long as there's a suitable reason to do so. And it doesn't matter on the time frame. Some carriers will place a time frame on it, but it doesn't matter on the time frame. So even if you partner with somebody who has sold annuities and you want to get Medicare referrals out of them or life insurance referrals out of them, talk about working their book with them on recross-selling everybody there. Replacements have never been higher in our industry. This is why suitability is taking forever. Our average replacement in suitability, and we have to write cover letters. We're writing to not only the suitability directors of some of the biggest insurance companies out there, a lot of people on the team, emails back and forth just to get things approved, because there's so much scrutiny over all the replacements that are happening. But we're winning every single case because we're doing the right thing, and we're proving mathematically, it's not opinion, if they have one income product to another income product, if that new income product is higher in payment, why wouldn't you tell your client about it? You're not going to say anything and then have them get paid lower the rest of their entire life because you didn't want to go through the paperwork of replacements. Okay. You have to look at everything right now. All these companies are going through massive replacements. They're literally just sending checks back and forth to each other. Okay. So take advantage of it while it's still here, because we don't know what's going to happen in the future. Okay. Now, if the Feds do drop the rates, that should spur up the stock market even more, which it's magically high now. When that happens, what's going to occur? Things will start getting more expensive again. Inflation will tick up. It's just the way it works. So the prime rate will come down. People will say, oh, now I want to buy a house because I have a lower interest rate. Well, you also have to look at the home value increases based on the decreases of that interest rate. So one of my colleagues said, a mentor of mine, I talk to all the time, a very successful real estate investor, he goes, date your rate, marry your house. So if you love the house, you can always refinance. But think of it this way, because I'm going through the same calculation myself. We're looking to move. And if I want to move, I have to contemplate, okay, if I wait, I know interest rates will come down. However, if they come down, that means more people are eligible to buy a home, which means that the price of the home, the competitiveness of the market is going to increase. So my home value is going to go up, right? Even though I'm in a lower interest rate, But what's that break even point? You have to run those numbers. Just because you get, say, 5% interest rate versus 6.5%, that 1.5% difference on your loan balance may not shake out if the house is $200,000-$300,000 more per million, or 20-30% more based on whatever value, right? It may not make sense. Home prices can swing like that. It's usually like a trailing 6 months, but you really have to consider that. The other thing to consider, and this is stuff you can coach your clients through as well to show extra value, just throw a disclosure out there like, hey, I'm not a loan officer, right? Or a tax advisor. But you can talk about, what if you were to get a house now, while, like, at least in our market, Austin market, home values are down 20-30% right now in certain areas. Okay. Even my own house, it was almost 900,000. Now it's down to like, I could maybe get 6 for it if I'm lucky, but I'm going to rent it out because I don't want to move because I got a 2% interest rate. I'm going to rent that house out and then get another house because the house that I want, instead of it being, say, 1.5, now it's all the way down to like 1.2, right? Or if I'm looking at a $900,000 house, now it's going to come all the way down to like, say, 800. So I'll save myself $100,000. Yeah, I pay higher interest, but guess what? I can just refinance. And yeah, there's costs to do that, but it's thrown back into the loan over a 30-year amortization schedule. I don't care about that. If you really look at how much it costs to get a loan, it's expensive. I mean, you don't really feel it because it's all cooked into your payment. But then again, you live in your payment.